Okay, so chapter 16 is over dividends and other payouts. And you may be asking yourself, what in the world does this have to do with capital structure? Because that's what we've been talking about, is capital structure. And the answer is this: where does internal equity come from? What is if I had to point to an account on the balance sheet and say, which of these is the internally generated equity, which would it be? Yeah, the accumulated retained earnings. That would be the internally generated equity. And you could look at the per period internally generated equity as the addition to retained earnings on the income statement. Okay, now here's the understanding, or here's what we need to know about accumulated retained earnings. Basically, they are all the undistributed earnings of the firm. That's all the undistributed earnings of the firm. That means the more of our earnings we distribute, the less we're going to have in accumulated retained earnings, the less internal equity we have. On the other hand, the less we distribute, the more equity gets retained in the firm, and the more that internal equity that we have. And so that's how these payouts and capital structure are related, because whenever we do one of these payouts, whether it be dividends or share repurchases, basically we are draining equity away from the firm. So that's how this all ties together. Questions so far? Okay, now let's talk about the different types of dividends. The ones that you most commonly see are called regular cash dividends. Number one, they are regular, meaning that they're paid periodically. Most American companies pay quarterly. Most American dividend-paying companies pay quarterly. Do you think are companies required to pay dividends? Absolutely not. And what if a company has been paying a dividend of $1 a quarter forever and a day? What about the next quarter? Do they have to? No, they're not required to. In fact, those dividends are declared every single quarter by the board of directors. And if the board of directors says we're not going to have the money, then they either cut the dividend or they omit the dividend. Okay, now regular, they're getting paid quarterly, but of course they're not required to. There are actually some American companies that pay every 6 months, but they are weird and few and far between. Okay, now cash is the second part of this. We're going to see that there are other kinds of dividends. In fact, one, the stock dividend, but it does not represent an outflow of cash from the company. So that's our most common type, is the regular cash dividend. Now, sometimes the firm will pay an extra cash dividend. Now, why not just make the regular dividend bigger? We are going to see that the market punishes firms that cut their dividends. And if we are going along here and we have an extra $4 we want to pay out, our dividends would look like this: $1, $5. And now what are shareholders thinking? They're like, hey, we're going to be getting this $5 every time. And then what happens the next quarter? We're back to $1. And so what the firm would do would be to declare a regular cash dividend of $1 and then an extra cash dividend of $4. When they declare that extra cash dividend, that's a signal that this will not be repeated every 3 months or every 6 months. In other words, folks, this is a one-time deal. Don't get used to it. And we're going to see when we get to signaling why that's important. The extreme case is the liquidating dividend. Now, most of the time we're talking about paying dividends out of the earnings of the firm. But if you have what's called a liquidating dividend, you're paying out everything, not just those undistributed earnings of the firm, but also we're giving back the original capital. We're giving back the original capital. Of course, after all, that money all belongs to the shareholders anyway. So a liquidating dividend would work like this. I sell all the assets, I pay off all the liabilities, and then I send the remainder of the money to the shareholders. Now, do we typically see a lot of liquidating dividends? No. If you had a business that was set up for a temporary purpose, like catering for the next Olympic Games, as soon as those Olympic Games were over, it would make sense to sell all the assets, pay off the liabilities, and then pay out the remainder as a liquidating dividend to the shareholders. Sometimes we'll see companies that will sell their assets, and so there will be a takeover. And so the most common, what people will want to do is a merger or acquisition. It's a lot simpler. But what if you can't? What if they won't go along with that? Well, you have to have a supermajority of shareholders in order to get those approved. But just to get 50% plus one is enough to force a sale of the assets at the firm. And so you can actually take over a firm by buying their assets. And so now that firm is basically nothing but a ticker symbol and a huge pile of cash. It would make sense at that point for that firm to pay out a liquidating dividend to its shareholders. Okay, now companies will often declare stock dividends. And stock dividends could work like this. So there'll be like a 2% stock dividend. So if you own 100 shares before, you'll own 102 shares after. It's all smoke and mirrors. Because now, instead of dividing let's say there were 100,000 shares outstanding, the value of the firm was the value of the firm per share was divided by 100,000. Well, now we're dividing that same value by 102,000. And so when you multiply the share price times the number of shares outstanding, nothing has changed. No value has been created. In fact, a little value must have been destroyed because there's some administrative work that goes along with doing this sort of thing. I think stock dividends are kind of a stupid thing to do. But apparently enough people enjoy them that people keep doing this. Okay, now let's see. Stock dividend. No cash leaves the firm. No cash leaves the firm, so at least the equity hasn't gone down any, and the increased number of shares just means that the share price goes down. And then we've got some fun ones. Some companies declare a dividend in kind, and so one time Wrigley's Chewing Gum sent out a box of chewing gum, and then my favorite example is this crematoria offered their shareholders discounted cremations. Does anyone know what a crematoria is? What do they do there? Yeah, they burn people into ash so you can put them in a vase and set them up on your mantle, hey mom, that sort of thing. So it's like, hey, you could get a discounted cremation. Now, the fun thing is the shareholder is the one that's entitled to the discounted cremation. Does the shareholder directly benefit from this dividend in kind? No, their heirs in theory would, right? Questions before we move on? Is a stock dividend a real thing? Doesn't have any impact on value whatsoever. Okay, now, there are basically three ways that we can talk about dividends. First, we could just talk about the amount of cash that is paid per share. And if you go out and look at stock quotes, you'll see it this way, dividend per share. And so that's a dollar amount per share. Then also in stock quotes, you will see the dividend yield, which is the dividend expressed as a percentage of market price. By the way, that dividend yield is going to fluctuate every single day. Can you tell me why? Yeah, because the market price that we're dividing by gets larger and smaller, and so this dividend yield will fluctuate day to day. I had a student, and he came up to me and he's like, yeah, my dad and I have this foolproof investment plan. And I said, tell me your foolproof investment plan. He says, we've got this sorter from our broker, and it allows us to sort things in descending order of dividend yield. He says, and then we just buy the top stocks because they've got the highest dividend yield. And I said, interesting. I said, do you know how a firm ends up getting a high dividend yield? He said, no. I said, do you think it's because they've massively increased the dividend that they're paying? You think so? It's not. Why is it? Why is their dividend yield so high? Yeah, their share price is so low. He's like, well, hey, that's good. I'm getting it at a discount. I said, you're not understanding it. The price is low because they suck, right? And at this point, I said, well, what kind of companies are you investing in? And he says, oh, it was these dry bulk carriers. Those are the people that carry iron ore and grain and whatever else around. Well, at the time, the economic situation had put us in a point where those things were hugely in surplus. And it was just a matter of time trying to see who was going to be the ones that died and who lived. And here he was, and him and his dad had invested all their money in this kind of crap. Don't do that. If you see a high dividend yield stock, there's a darn good chance that it's there because the price sucks, and the price sucks because they're doing a bad job, or they're in a bad market. Then we've got the dividend payout. This is just a dividend per share as a percentage of earnings per share. So we would refer to this as the payout ratio. The payout ratio. Hopefully you guys remember the retention ratio. The retention ratio is the amount of addition to retained earnings divided by net income. That's going to be 1 minus the payout ratio, because those two things added together equal net income. So that's why that works that way. Okay, so those are our 3 ways that we're going to talk about talking about dividends. This is the procedure for a cash dividend, and I want you to note something on your slide. Somewhere around 2022, I think it was, I was doing the research today, because it was interesting. I have been for years teaching that the ex-dividend day happened 2 business days before the record date. And that's what this says right here. But this morning, when I'm reading chapter 16, the new updated live version, it says it's only 1 day before the date of record. And I thought, they can't both be right. And so I did a bit of digging. And here's what I found. That the articles that are written about this on places like Investopedia, they were all corrected around 2022 to represent this change from 2 days before the record date to 1 day before the record date. Now, who comes up with that rule? It turns out it's the stock exchanges. And it makes sense that the change would be, that it would be going in this direction. Here's why. Back in the old days, all these trades had to be matched up manually via paper. And so you didn't know exactly who did or didn't own the shares the day before, but you would 2 days before, because there was a 2-day settlement time. But now we're down to where we have everything settled within 24 hours. And so as a result, now they have narrowed this down. For purposes of the single practice question that asks about this, assume that it's 2 days. But now in reality, it's only 1 day. So if we were looking at current, this would be for 2023 or 2024, we would be looking at January 29th as the ex-dividend date, not January 28th. Okay, so let's talk about these dates. First of all, we have the declaration date. And we said that the firm does not pay a dividend unless it is declared by the board of directors. And the dividend is not a liability of the firm unless it is declared by the board of directors. What is a liability? Just give me your rough definition of what is a liability. Yeah, something you're going to have to pay, right? And so it's a legal obligation to pay. The firm has no legal obligation to pay the dividend until it's declared by the board of directors. So this is declaration date, and here's what they would say. We're going to pay a dividend on Monday, February 16th, to investors of record as of January 30th. That would be what the announcement would look like. Now keep in mind, they're doing all this back in mid-January. They're doing this declaring. Okay, so the ex-dividend date is the first date the shares trade without this dividend that's getting paid. Ex-wife means without wife, right? Ex-dividend means without dividend. So if you buy it on the ex-dividend date, you will not receive the dividend. Let me repeat that one more time. If you buy it on the ex-dividend date, you will not receive it because after all, ex means without. If it is before that date, the stock is considered to be cum dividend. Cum is Latin for with, like when you graduate cum laude, right? That's with honors or something like that. And so cum dividend means that you've got the dividend. Ex dividend means without. So in our example here, if you wanted to capture that dividend, you would have to buy the stock. Under the old rules, you'd have to buy it on January 27th. Under the new rules, you'd have to buy it on January 28th. I did some looking this morning, and I'm still seeing some that report 2 days. But here's what you want to do. Always look up the ex-dividend date for the particular stock before you try to do some sort of trade related to dividends. Okay, the record date, that's the list of all the individuals that they believe to own the shares. That's what's going to happen. The company actually does that. And then they have the payment date. The dividend is actually paid on that date. What do we mean? That's the date that the check gets mailed out. And if you know any old people that own stocks, they've got all these things in their head as to when these checks should show up in the mail because they know the date they're mailed on, they know how long it should take to get there, and this is like my dad's 4 favorite times of the year, right, when the dividends show up. Any questions about the order?
Not necessarily the order, but in terms of our test, what should we assume in terms of the ex-dividend date?
This is a good question, and I knew you were going to ask. I actually looked at every question on the test, and that particular discrepancy doesn't show up. The only place I found it was in that one practice problem.
And I because I saw the practice problem too.
Yeah, so you only saw one. Now everything else is conceptual. Things like if you want to get the dividend, which date should you buy it on? Should you buy it on the declaration date, on the ex-dividend date, on the record date, or on the payment date? And of course the answer is the declaration date because all those other dates are ex-dividend. Question, good question. Other questions? Okay, let's talk about what happens to the stock price. So, keep in mind that when a company pays out a dividend, the value of the firm drops by that much, in theory. Mr. Stith, what's going on?
I was talking about the ESG.
Oh! Okay, let's take a little side here. Did you guys pay out a huge dividend?
No.
No, we took away it.
What did I tell you when we were talking about these things? I said, okay, the investor expectation is that you pay a dividend and that it grows. I said, but inevitably, some dumbasses will come in here and immediately cut the dividend. You guys were in class that day. Does this mean you self-identify as dumbasses?
Yes.
We cut the dividend.
You cut the
$1.10.
Folks, you're going to find out after today that you can have other good news that outweighs that. But if that were in isolation, that's just bad, and we're going to see why.
We didn't do
Okay, so you found some other way to suck. That's what you're telling me? Yeah. Okay. Thank you. Okay, so back to the story. With a dividend, you're paying out a portion of the value of the firm. And so, of course, the stock price should drop. And if we were in a perfect world with no transactions costs, no taxes, none of that frictional stuff, the share price would drop exactly by the amount of the dividend. So we would have a stock here that was trading at price P, and then after as soon as the ex-dividend date hits, then the price would drop, because the day before it was worth P, the day before, or on ex-dividend on ex-dividend day it's worth P minus dividends, right? Okay, now in theory, if you paid out $1, the stock price should drop $1. But it doesn't actually drop the entire dollar. And here's why. Because the people receiving the dividends have to pay taxes on them. And so let's assume that the majority of our shareholders are paying 15% taxes on their dividends. Then they're only going to be getting 85 cents worth of value from that dividend. The share price will only drop 85 cents. And so that's where the complication of taxes comes in. It actually kind of cushions this drop. It doesn't drop as much. Questions? Notice it says it happens within the first few minutes of the X date. In other words, it closed at this price, and then basically it opens at this new reduced price. Do not assume that you can jump in there at the first of the day and find the price actually higher. Of course, the only thing you could do that would benefit you in that would be to short the stock, right? If you thought you could grab it at the bell and then let it go down. It's going to be just a matter of seconds. Now let's talk about the irrelevance of dividend policy. First of all, let's make clear, dividends themselves are relevant because they are cash flows into the hands of the investors. That's meaningful for people. But to the value of the firm, which is what Modigliani and Miller specialize in, is there relevance to dividend policy? And the argument is going to be that in a world without taxes, transaction costs, and all those imperfections, that dividend policy is irrelevant, meaning that no matter what you do, you're going to end up with the same value for the firm. Okay, now, what's the nut of this argument? Do investors really need us to pay dividends in order for them to be able to get their money out of the firm? No, what could they do instead? Yeah, they could sell their shares. Now, the argument used to be transactions costs would make that prohibitively expensive, and so they were saving on transactions costs by getting dividends in the mail. My dad still remembers those days when you had to pay $300-400 to make a stock trade, and so the idea of selling shares instead of getting dividends was an anathema to him. But for me, with my Charles Schwab account, how much am I paying in commissions? Basically zero, right? But the only transaction cost for me is the bid-ask spread. So the transaction costs have dropped a whole lot. And so that part should make dividend policy less relevant. But we still, of course, have taxes. So dividend policy in a world without taxes and transaction costs is not going to impact the value of the firm simply because it's really not impacting the value of the cash flows streams that they're going to get. They could either, we're going to talk about homemade dividends where they could sell the stock, lots of things they could do to basically reverse any dividend policy the firm might come up with that they don't like. And so once again, just like capital structure, we talked about homemade leverage and homemade unleverage and why that made capital structure irrelevant in a world without taxes. We have a similar argument for dividends. So let's do a homemade dividend argument. Yankee is a $42 stock about to pay a $2 cash dividend. Bob Investor owns 80 shares and prefers a $3 dividend. Does Bob just have to cry and feel bad and not actually get the $3 that he wants? No, because Bob could actually sell some of his shares to produce that extra dollar. So let's talk about the value of his holdings as a result of these scenarios. If he just had the $2 dividend, he would be getting $160 cash. How do we come up with 160? Yeah, it's just 80 times 2, right? Bless you. Okay, so the total cash that he received would be 160. And what's the value of his remaining stock holdings? Well, he still has 80 shares multiplied by $40 per share. By the way, why did the share price drop $2? Yeah, it was a $2 dividend, right? And we're in a world without taxes. And so now the shares are worth $40 a piece, 80, multiply that out, you get 3,200. If I add 3,200 and 160, the total value that he is now holding in cash and stock is 3,360. Okay, now let's look and see how Bob manages to get his extra money that he wanted. Remember, he wanted $1 extra in dividend. And so what he's really looking for is an extra $80. And so how does he go about doing that? Well, he gets the 160 dividend as before, and then he sells 2 shares, which would net him $80. And that's going to give him total cash of 240. Now the question is, how much is his stock holding worth now? Well, it's only worth 40 times 78. Why are we now multiplying by 78 instead of 80? Yeah, he sold 2 shares. And so what's left over here is 3,120. If I add 3,120 to 240, we're right back to 3,600 or 3,360. And so it doesn't matter to his wealth which one of these things that he does. It doesn't matter. So the homemade dividends gives us the same kind of irrelevance argument that homemade leverage does. Question?
What if he sells before the ex-dividend date and gets the $42? I mean, is that something you could...
Okay, so if he sells before the ex-dividend date, he will not receive the $2 on those shares.
Okay.
And so what would happen there is his cash dividend would be less, and his dividend from selling the stock would be, or his amount from selling the stock would be more.
Okay.
Does that make sense? Good question. Any other questions? Well, hey, we just walked through all that. So what we're looking at here, the extra 80 was just for the 2 shares that he sold after or on the ex-dividend date or later. So now let's talk about dividends and investment policy. Remember that we are using the debt and equity of the firm to invest in assets. What kinds of projects should we be taking on? I'll get you started with this. What's the goal of financial management? Maximize shareholder wealth. As a result, we should only be taking on what kinds of projects? Positive NPV. Now, dividend policy, one of the things that when Modigliani and Miller talk about this is they start out with the assumption that the investment plan of the firm is fixed and is independent from dividend policy. And that's how they get around this problem. But here's the problem. Is it in the benefit of shareholders, maximizing shareholder wealth, if we forego a positive NPV project in order to use that equity instead to pay out a dividend? Is that maximizing shareholder wealth? No. When you forego positive NPV projects, you are not maximizing shareholder wealth. And so one of the things that we're going to say here is that you should never forego a positive NPV project just to increase a dividend or pay a dividend for the first time. Don't do it. Remember, the rule is undertake all positive NPV projects except all positive NPV projects. Questions? By the way, typically what we want to do is think about the investment decisions first and then think about the financing decisions. We're going to figure out what all these positive NPV projects are, and then we're going to figure out how to fund them. And in the United States, we do have a great capital market system where if we've got a positive NPV project, can we typically get funding? Yeah. And so it doesn't make any sense for us to forego positive NPV projects. Now let's talk about the repurchase of stock. There are basically two ways in which firms can return money to the shareholders. The first is the dividends that we've already talked about, but the other way is the repurchase of stock. The firm can go out there and repurchase its own stock. Now you might think, wait a minute, that only gives money to the people who sell their stock. But it's not true. What happens to the value of the remaining shares? Yeah, so the remaining shares might be worth more. Okay, so let's take a look here at what's going on. We've got this chart. It's hard to see because the blue and the green are similar, but the top line there is blue, and the middle line is green, the bottom line is red. The top line is reported earnings, and it is the most jagged one that we see. The second one is buybacks, and it's the second most jagged one that we see. And the red one is dividends. Now I want you to notice that dividends is the smoothest line up there. And we're going to see that there's a reason why that is. We say that dividends are sticky. People are, managers are reluctant to raise dividends if they think they might have to cut them. And the reason they are reluctant to cut a dividend is because we have this asymmetric impact on share price. If you raise dividends by $1, you're going to get a nice little bump in your stock price. If you lower dividends by $1, guess what? Yeah. Okay, so there you go. That's why you may see dividends being more smooth like this. Well, now the question becomes, what does that mean that we should be doing about repurchases of stock? Repurchases of stock are good when we've got extra cash, but we're not sure we're going to have huge cash flows persisting into the future. So you remember the extra cash dividend that I talked about? I would actually go about that through a repurchase of stock instead, because then you don't run the risk of confusing any widows and orphans, as the books call them, the people who accept the dividends. Consider a firm that wishes to distribute $100,000 to its shareholders. So we've got right now cash of $150,000, other assets of $850,000. So the total value of the firm is $1 million. So therefore the equity of the firm is $1 million because we have no debt. The shares outstanding are 100,000. The price per share is $10. The price per share is $10. Okay, now what happens if we use $100,000 to repurchase? Oh, the first example is going to be dividends here. So if we use the $100,000 cash dividend, what's going to happen? Our cash is going to go down by $100,000, and our dividends, our equity is going to go down by $100,000. And so afterwards, the price per share is going to be $9. The price per share is going to be $9. Okay, so everyone who had one share stock now has $9 of stock and $1 of dividend. So total of $10. Does that make sense? Okay, now let's look at what the repurchase does. It turns out the balance sheet looks exactly the same. The difference comes with the shares outstanding. The shares outstanding is now $90,000. And if we take our $900,000 value of the firm and divide by 90,000, we have $10 per share. That's exactly what we would have had with the dividends, right? And so this is an argument for irrelevance between repurchases and dividends. Now, the one thing we can say is that the share price is higher with the repurchase, but it's because we are dividing a now smaller company by a now smaller number of outstanding shares. I'm going to give you some arguments later on why share repurchases should increase stock prices, and in truth they do. We see that. By the way, have the operations of the firm changed any? No. But now, instead of owning 10% of the firm, now you own basically 11% of the firm. And so the percentage of the future cash flows that you own are higher as a result of the share repurchase. Now, what about someone that wanted to get out from underneath the stock at this point? It's a great opportunity to do that. So let's talk about dividends versus share repurchases. The first bullet point here says flexibility for shareholders. Here's what we mean. If the firm declares a dividend, do you have the option to reject that dividend? No. That check is going to come in the mail whether you like it or not. The stock price is going to drop whether you like it or not. And so as a result, we see that it is in this dividend payment thing is inflexible. If I don't need the money, there's no way for me to say no thanks. But with share repurchases, it's a lot more flexible for the shareholders. If I don't need the money right now, maybe I don't get in line to have my shares repurchased. And so it gives me more flexibility. Also, one of the arguments here when we throw taxes in is that dividends, you are forced to pay the tax when the dividend is given to you. But what if you're looking at capital gains, which is where the share repurchase tax would come when we have to pay for that? You get to choose, right? You don't have to sell those shares unless you want to. And so there's a lot more flexibility there for shareholders. I would also say that there's more flexibility for managers. Remember, we said we're only going to raise the dividend as much as we know we can absolutely continue to pay going forward because we don't want to have to cut it. But we can make an announcement that we're going to go out and repurchase a bunch of shares, and then if hard times hit, all I have to do is not repurchase as many shares as I said. And so there's a lot more flexibility in that. But on the other hand, that means that a repurchase does not have the same strength of signal about future cash flows that a dividend increase does. Now, it keeps the stock price higher. Why would anyone care? We just said if someone got $9 plus the $1 in dividends, it would be worth exactly the same as the $10 with the stock repurchase. And the answer is this. Anyone with stock options would prefer a repurchase because the repurchase keeps the share price higher. Now, by the way, the people who are coming up with a recommendation on paying dividends and repurchases are the managers of the firm. How do managers of the firm get a lot of their compensation? Yeah, the stock option, the stock options. Okay, so let's say that when the stock price was $7 a share, they gave, no, let's make it 5. When the share price was $5 a share, they gave the managers the opportunity, they say in 1 year, you can buy the shares for $7 a share. Now, the only way that option pays off is if the share price goes above $7 per share. And now the managers are sitting in the situation of our example firm, and they say, we can either pay out a dividend, after which the share price will be $9, Or we can do a share repurchase after which the share price is $10, which is more attractive to these managers. Yeah, the $10. And so what they're going to do is do a share repurchase, and then when they exercise their option, they'll be getting 10 minus 7 or $3 instead of 9 minus 7 or $2. So they would have juiced their bonus by 50% just by choosing to do a repurchase versus a dividend. Now, you may also hear the argument that the reason that they do repurchases is to offset the dilution of the shares. We know the dilution argument is crap because basically the value of the firm is the same regardless of the number of shares that are out there. And so the idea of dilution is that when managers exercise their options, when they do that now we're going to have a higher number of outstanding shares. And the number of outstanding shares will continue to grow unless the firm does share repurchases to bring them back in line. So under this argument, that the firm would just repurchase as many shares as the managers exercise options. So just to keep the same number of shares outstanding. The next one is my personal favorite for arguing for a share repurchase. What if the shares are truly worth $12 per share? Would it make sense to buy them back for $10 per share? Absolutely it would. And in fact, in the 1980s, there was a period when General Motors, their stock was undervalued, and the best investments they made were not in factories or machines. The best investments they made was in buying back their stock. Now, of course, they eventually turned that place into a toilet, but at the time, that was the best use of their cash. If the managers think that the shares are only worth $8 per share, are they going to repurchase them for 10? No. And so what we see here is that a repurchase can be a positive signal about the value of the firm. We know at the very least that the managers do not think that the shares are overvalued. Does that make sense? So by the way, a share repurchase is just the opposite of share issuance, right? And we said when a firm issues additional shares, what happens to the stock price? What's the signal when they issue additional shares? Remember the pecking order?
We can't get debt financing on this.
Yeah, so they've used up their internal equity, they've maxed out on their debt, now they're having to come out here to the market. Or it's a project that sucks badly and they know it's going to be bad, so they'd rather share that misery with new investors. And so what we see is the stock price goes down when they issue additional shares, so when they repurchase shares, it makes perfect sense that stock price on the same logic would go up. And then finally we have tax benefits. And I've already mentioned the whole timing thing. So dividends, you're going to have to pay those taxes whether you want to or not. But with share repurchases, you are making the choice to do that. So you're going to have you're choosing your taxes. Now, why would that matter? If we had a flat tax rate, it would not matter. But if we have, like we do, this progressive system, what I can do is wait till I've had a really bad year, and then I can sell my stock. And so the capital losses that I'm currently experiencing would be offsetting this capital gain, and I won't owe any money in taxes. Now, even if we're not in that kind of a situation, we're still only paying tax on that amount of the capital gain. So assume that you bought the shares for $6 a share, and then you sold them for $10 a share. How much are you going to be paying taxes on? Yeah, the $4. Now, so if you assume that the firm pays a $100,000 dividend, both eyes are open now. If you assume that the shares are going to pay, or that the company's going to pay a $100,000 dividend, how much of that is taxable? Oh, come on, they're gonna pay a $100,000 dividend, how much of that's taxable? All 100,000, right? But let's assume that they pay out that $100,000 in a repurchase, and they're buying the shares for $10 a share when the people paid $6 per share. Now, only of that $100,000, only 40,000 of it is taxable. And by the way, if the tax rates were hugely different, you could still come up with an argument why dividends might be better, but I want to show you that they're not. I looked this up this morning. Oh, here it is. Stop that. Capital gains and dividends are taxed at the same rates currently. Capital gains and dividends are taxed at the same rate currently. So there's no way that you can make the argument that you could still have a greater benefit from dividends. Dividends would have to be taxed far, far less than capital gains in order for that argument to stick, and it just doesn't. By the way, the amount of money you pay on the dividends depends on your income. And so if you've got married filing jointly up to $83,350, you don't pay any taxes on your dividends. And if you get up to between 83 and 517, you're paying 15%. If you're above 517, you're paying 20%. And so what would that predict about the desire of people to receive dividends versus capital gains? By the way, the $517,000 folks, do you think they're going to have possible capital losses they could use to offset? Yeah. Those people, in theory, should not be wanting to do dividends. And the low-income people, in theory, should be thrilled with dividends because, number one, their income's low, and number two, they're not paying any taxes, whether it's capital gains or dividends. So the rate might be the same, but there's still arguments for why low-income people would prefer dividends and high-income people would prefer repurchases. Any questions? Yeah.
Is that for short-term capital gains or long-term?
Okay, he asked a very good question. This is long-term capital gain stuff. Short-term capital gains are taxed as ordinary income. And the income tax brackets go all the way up to 39.6%. And so if you were doing short-term capital gains, you could see a much higher tax rate. By the way, what's short-term capital gains?
Less than a year.
Yeah, less than a year. These people that are day traders, if they're making any money, they are the government's best friend, right? Because they're churning, they're getting these short-term capital gains, and they're paying high tax on that.
You can't take, like, if you had a capital loss, or actually, is that a thing where if you were selling within a year, you had a whole bunch of losses, can you offset that from your ordinary income?
So you would have, I don't think you can do it from your ordinary income, but you can offset it against your capital gains.
Oh, okay, I see.
And so, does that sound right? Yeah, I'm not a tax guy, but that's my understanding of it. And that would explain why you would be willing to, so if I had a capital loss and I had no capital gains to offset that, basically, so you could do, is there a capital loss carry forward? I use TurboTax. I don't know these things, right? Ask Dr. Philpott. But if the capital loss is only good for this certain tax year, it would certainly make sense to go ahead and sell something and get your capital gain out of it, and that way you could offset that capital loss and you could get some cash without paying taxes on it. Does that make sense?
Yeah.
Okay, yes?
Is dividend like reinvestment treated any differently, or are you?
Oh my goodness.
Is that taxed automatically?
Yeah, so he's talking about DRIP, dividend reinvestment programs, right? And that is where you just immediately have the dividends reinvested. You might think, well, hey, that'll keep me from having to pay taxes. Wrong. You're going to go ahead and pay taxes on those dividends. And you say, well, wait a minute, but the exact amount of the dividend got reinvested. Yeah, but when you do your taxes at the end of the year, you're going to end up having to pay more taxes because you receive those dividends. Questions? So dividends now, they've got these qualified, unqualified, and stuff like that. So an unqualified dividend would be one from something that you would be getting a short-term capital gain from. So if I bought it within the last year, the dividends are not qualified. And so this is going to, if you want to try to play these games with buying on the cum date and selling on the after the, you're not going to make as much money with that because you're going to have to pay these short-term capital gain type tax rates on those unqualified dividends. Every tax season, my dad and I have this discussion about qualified versus unqualified, and every year I just take what the broker tells me and I plug it into TurboTax. Every year my dad goes through all of his and tries to figure out whether they're qualified or unqualified, and then he does his taxes by hand. Who do you think gets their taxes correct more often? I do. I finally talked him into letting someone else do his taxes. But it's just amazing. Every year he'll like get $3,000 back. And I'm like, Dad, what are you doing wrong? And he says, well, I messed up my whatever again, right? So my point to you is this: the dividend laws are far more complex than they used to be. Take what your broker gives you, put that information into TurboTax or give it to your tax preparer. By the way, what's a good reason to use TurboTax other than a tax preparer? Well, it's free for a certain group of people, but even for, I'm paying less for TurboTax than I would pay for a tax preparer. Plus, I don't have to hand over all my information to some stranger. Does that make sense? And I hate it, but I know at some point I'm going to have someone else do my taxes. Because my dissertation advisor, one of the pieces of research that he did was he figured out the age at which people stop making financially sensible decisions. And the age is 70. I'm only 18 years away from having to have someone else do my own taxes. My dad stretched it out to 80 before and so he had like 10 years of the IRS either showing up at his door or mailing him a check, right? Okay, other questions about dividends and taxes and whatnot? So, to get to dividend policy irrelevance, we need 3 assumptions. We've been talking about no taxes, no transactions costs, and then also no uncertainty. No uncertainty. Now, what do we mean with the no uncertainty? There's an argument to be made for dividends, and it's called the bird in the hand argument. And that is that I would rather they pay a dividend now because I know at least those bastards will not lose that money. Does that make sense? Because have you ever heard the argument a bird in the hand is better than 2 in the bush?
Yes.
Okay. This is interesting. You have not heard that.
I've heard the 2 in the bush, but I've never heard the whole saying.
Apparently you've just got some bush-centric people in your world.
Really?
The first part of that is that you have to have a bird in the hand versus 2 in the bush. So it's better to have 2 birds than 1, right? But the bird in the hand is the certain bird. The 2 in the bush, are either one of those certain to you? No, they could both fly away, right? And so that's the argument of here. The dividend policy would be irrelevant if we didn't have uncertainty. Okay, now, I just showed you what the latest is on that, so you could scratch that as of 2019 because it's still that way. And we talked about the fact that capital gains can be deferred. So the tax rate on dividends, therefore, is greater than the tax rate on capital gains because you can defer them. And the further out in time that we pay taxes, as long as it's the same amount of taxes, it's worth less from a present value standpoint. And then, of course, once again, there's also the argument that we're not paying on the whole amount, we're only paying on the capital gains that we get from that. So that's argument for the repurchases. Now, what if a firm doesn't have sufficient cash to pay a dividend? In a world without transactions costs, without taxes, without uncertainty, it would be perfectly fine for such a firm to issue more shares in order to be able to pay a dividend to their existing shareholders. It would be perfectly fine. But we do live in a world with taxes. We do live in a world with transactions costs. So here's what would happen. When the company went out to issue new shares, they're not going to get 100% of the money that comes from those new shares, because there will be a company called an investment banker that is involved in the issuance of shares, and they will demand something called flotation costs. And so the flotation costs of those shares, probably somewhere around 7.5%. And so we're already down now to 92.5% of, so if we issued 100,000 in new shares, we've only got 92,500 to work with. Now we turn around and we pay that out to the shareholders, and the shareholders are going to have to pay taxes on that. And so now from the original 100,000 in shares that we've issued, we've only got 92,500 minus taxes going into the hands of the shareholders. And so we've got two forms of loss there that tell us that it is crazy to go out and issue new stock to pay a dividend. Now, we will see that there might be an argument for people being willing to do that. But the argument is based on this. So let's think about if the cash flows of the firm have been pretty good, and then we've got a temporary, and we know it's temporary, we've got a temporary downer here. We know if we go out and cut the dividend, what's going to happen to our share price? It's going to get hammered, right? And so it makes sense at that point to raise money from the outside and still go ahead and pay that dividend, because it sends a signal, and we'll get to signaling here in a minute, but it sends a signal that things at the firm are better than they might appear, that this is just a temporary problem and we're going to get past it. But let's think through this. We said we have to have external financing to be able to pay the dividend. But would we do it by issuing new shares, or would we do it by taking on debt? Think back to the pecking order. If you need money, your first source is internal, but we don't have that money. Where do you go next? Debt. We go to debt. And the reason we go to debt is it is a stronger signal that we are going to be doing better in the future. Because if we go with a share issue, what does it say about the value of our shares? Those shares must be overvalued, or we wouldn't be willing to issue more of them. Does that make sense? And so from a signaling perspective, if you don't have cash to pay the dividend because of something temporary, and you want to send a signal that you are still in good shape, what you would do is go out and borrow some money, which is a positive signal we talked about last time, and use that money to pay the dividend, which is also a positive signal about your future cash flows. Does that make sense? I cannot think of, unless you could not in any way, shape, or form raise equity or raise debt. If you could not borrow money at all, that's the only reason I can think of for issuing additional shares to pay a dividend to send a signal. By the way, the two people that are happy that we did this little exercise are the investment bankers and the government. Because after all, the investment bankers got 7.5%, and then the government gets 15% of what's left. So what about firms with sufficient cash? Well, let's talk about what is sufficient. Here's what's sufficient at the firm. After we've paid all of our bills and we had invested in every single positive NPV project, and we have set aside a reasonable cushion of cash, and we've talked about that before with liquidity needs, then anything left over is excess cash. Anything left over is excess cash. Okay, so there are a lot of alternatives here to doing a dividend. So what I would tell you is that firm either needs to pay a dividend or do a share repurchase. But what we often see is that they will select additional capital budgeting projects. We just said that we have already accepted all of the positive NPV projects. What does that mean about the remaining ones? If it ain't positive, it's got to be 0 or negative, right? What would the rule tell us about that? Tell us not to do it, right? And so they are blatantly violating the NPV rule when they do this. But the argument that they would say is, well, it's better for the shareholders to lose 2% of the value of their money than 15% when they have to pay taxes on it. So that would be the argument that they make to justify that. They could also use this extra money to go out and acquire other companies. And we see this a lot. When firms get excess cash, one of the things they like to do is go out and buy other companies. Now, when I say firms like to do this, in reality what we're talking about are the managers. They could use the same argument that they do with the negative NPV projects, that by the time you guys pay taxes, we're better off to go ahead and acquire this other company. But the expense for acquiring another company is quite high because you have to pay something called a premium to take over that firm. If the firm's share is currently selling at $10 a share, I'm not going to get any of you to sell marginally for offering you $10 a share. I've got to offer you $12 a share. I've got to offer you $14. So I'm going to have to pay a premium. So there's the first source of value loss. We're also going to get investment bankers involved, and they like money. They're going to take some more money. We've got to get accountants. We've got to get lawyers. All sorts of costs involved in acquiring other companies. So the question is, why do managers go ahead and do this even though they know it's a bad deal? And we do know it's a bad deal. Richard Roll, 1986, in this paper called The Hubris Hypothesis, he looks at the studies on acquisitions and he says that the vast majority are non-positive. What does non-positive mean? 0 or negative, right? So they're either not doing anything to shareholder wealth or they're destroying shareholder wealth. We know this is a bad thing, but managers do it anyway. Any ideas why? So first of all, do you think managers have a lot of self-confidence? I'm being nice about this. Do you think they're arrogant? Yeah! By the way, I'm a freaking CEO of a Fortune 500 company. I must be something special. Therefore, I must know things that other people don't. Therefore, I am able to pick out these targets that other people just don't understand the value of. So that's the first one. We call that hubris. And then we have the problem of empire building. That is where we all know that the CEO of a bigger firm is more important. They get paid more. They get a better tea time at the golf course. They have a better looking romantic partner. We know all these things to be true. And so this is why you'll see these managers go out there. First of all, they've got over too much self-confidence. And secondly, they are doing this for their own benefit. Do the shareholders care how attractive the CEO's romantic partner is? No. It doesn't bring value, right? But the benefit, therefore, what we're saying is the benefit, it flows to the managers. Then they can also purchase financial assets. This might make sense if we had differential tax rates, where the corporate tax rate was much lower than my tax rate on interest or dividends or capital gains. It might make sense for them to go out and purchase these financial assets and hold them for me. But We're in a situation where that's not the case. It really doesn't make sense. So it would be better for them just to send me the money. If I want to buy those financial assets, stocks, bonds, can I do that for myself? Absolutely, I can. And then finally, of course, repurchase shares. And so of all the alternatives to dividends that we have up here, which one of those is the best one? Repurchase shares. Repurchasing shares is the only one on that list that we say is, we cannot find anything wrong with it. Now let's talk about taxes, issuance costs, and dividends. Actually, okay, so I basically said all these things today. A firm shouldn't issue stock to pay a dividend. Have I already said that? Yeah. Okay. Managers have an incentive to seek alternative uses for funds to reduce dividends. Did I just get through saying that? Yeah. Though personal taxes mitigate against the payment of dividends, what does mitigate mean? Yeah, it's going to lessen the benefit or the risk. It's going to mitigate against the payment of dividends. These taxes are not sufficient to lead firms to eliminate all dividends. By the way, personal taxes, we just saw that a large group of people out there don't have to pay any tax at all on these dividends. So it's a very poor excuse when managers say, oh, well, we're just saving these poor saps from taxes. And under the current tax law, shareholders generally prefer a repurchase to a dividend. And it was for the reasons that we said. The dividend is you're forced to do it, you don't get any say in the timing, and you're having to pay on the entire amount of the dividend as opposed to just the capital gain when you do a repurchase, and you get to choose when you take that capital gain. Question?